extensively in M&A, inbound and outbound tax structuring, cross-border transactions, and global reorganizations. His clients have been both Indian and international firms in sectors including advertising and service, infra, manufacturing, pharma, retail, and technology. He has been regularly nominated as the leading tax advisor by Euromoney in the last decade. He has co-authored a book on general anti-avoidance rules, that is GAR, Establishing Substance Over Form, published by Bloomsbury, UK. Our second speaker, Mr. Amitabh Khemka, is the lead partner, Global Indirect Taxes at KNAV. He has over 20 years of experience in the area of indirect tax, including with KPMG India, Vodafone, BMR Advisors, and Steer Advisors. His core areas of expertise are tax cost optimization, tax efficiency opportunities, transaction structuring and supply chain mapping, risk mitigation, standardization, automation, and implementation of tax processes, advocacy, and litigation. He has assisted businesses implement GST with respect to tax, technology, trainings, and tools. He was a member of the Working Group on GST, a subgroup of the Empowered Committee of State Finance Ministers in India. Our third speaker is Mr. Krishna N., who is a tax partner at KNAV and is based out of the Bangalore office. In his prior experience, he has worked with Big Four firms and BMR advisors. Joining us today to give us an industry perspective on the Union Budget 2023, our fourth speaker for today is Ms. Heena Shah, who is the head of International Taxation and Transfer Pricing at Tech Mahindra. She has been associated with TechM for the last 15 years and has vast experience in her field. She has adeptly navigated and driven various critical overseas tax and transfer pricing litigations. She has received many accolades from the organization, appreciating her contribution. Today's discussion shall be moderated by Taxsutra's co-founder and group editor, Mr. Arun Giri. Before I hand it over to Arun, I would like to take the opportunity to apprise all of you that in the last 10 minutes of the session, we will host a dedicated question and answer session. For this, you may post your queries in the Zoom Q&A box. With this, I now hand it over to Arun.
Thanks so much, Tanaya. Union Budget 2023, I said yesterday evening was uneventful. It was like the middle overs of a cricket match with, where you take ones and twos and don't try any reverse hit or the switch hit, the reverse sweep, the 6 over the wicket keeper. No, but the action was somewhere else late last night. So the real action began after the budget. The real action began after the markets closed. And we saw one of the biggest events that corporate India has seen in the last several decades. And I'm saying that as a journalist with 2 decades experience. So India is never short of action, except that the action yesterday was a little less in the budget and little more elsewhere. That's how life is. You have to factor in everything. But the budget itself, it never fails to engage tax professionals. So the first reaction after reading the fine print was, "Isme kuch nahi hai. This is mundane." But no, that's never the case. When you read the fine print, then you read it again after having a coffee at 1 in the night. Then you again read it at 3 in the morning while finalizing your firm's alert. At that time, you come across some issues, something that you may not have seen in the first reading. That's the beauty of being a tax professional, that every time you read the same provision, you can come up with a different interpretation. Don't the courts do that often? It's the same with us as well. So with this context, I commend this webinar to Uday Ved. But before I do that, we'll ask a quick question to each of our panelists. We will start with Heena, who's the industry representative working with a large IT company. Heena, overall on the tax front, would you say no negative surprises, and that should be good news for you?
Yeah, hello. Hi, good morning to everyone, and good morning, Arun. Yeah, I think you aptly summarized it. No negative surprises, but yes, some shortcomings. We'll speak about it. Yes.
Any big positives for you? Anything that a couple of quick takeaways from you, Heena?
I don't know. Nothing major. Only on the personal income tax front, some tidbits, but nothing major. No.
Fine. You're going to be opting for the old regime or new regime? Quick.
I guess the old regime.
Yeah, I think that's going to keep chartered accountants busy for the next 12 months. Uday, your quick takeaways on the budget, 2 big hits and 2 big misses.
Okay, so I think you said the middle over match. I don't necessarily subscribe to that. I think there are some real good measures, not only on the tax side, but on the overall economy and everything. When we are talking of tax, no surprises or no negative surprises is a good news. It's more on the administration easing out everything. But in my view, this on the tax front, the new tax regime, I think is a game changer. Maybe people on this call here may not be necessarily be representative. If you look at it from a common man perspective, people earning up to 15 lakhs, there was already a scheme which has been revamped. So it takes guts to admit that something that government did 3 years back, it didn't work out, and we are trying to put that and putting it to rest. Even from that perspective, if you look at it, people earning up to 15 lakhs, definitely it's a good regime. Not only there are tax savings at each level, but easing out, just filing the tax return, and getting away with. Now, people may still prefer with the old regime and everything, and chartered accountants and tax advisors, you always have a field day. So that's one positive in my view, tax savings as well as more easing out. Even at the highest level, nobody expected, in my view, that there will be a reduction in the tax rate or a surcharge at least that put together. So effective reduction of 4% at the super rich level again is a major step which has been taken. And in fact the thought was whether it will go further away from it, right? It will possibly increase or no reduction. People were happy with it. So 43 to 39% again is a big change, 4%. And people in this call again would possibly be affected by that in a more positive manner, I would say. So these are the two from a more tax perspective. On a corporate tax front, again, no tweaking. I think is good. You don't need 4s and 6s all the time, Arun, as you were just said in a lighter note. One could have said there could have been a tweaking between the service tax rate, service industry tax rate, which is 25% and 15% for manufacturing. Why are we making that distinction, right? Trading companies possibly could have been a higher rate, but 25 itself, 22 or 25, the way you look at it, is a very reasonable rate. Again, as I said, the expectation was more to see that if you are giving a manufacturing a thrust, India is a big service industry, right? So service sector could have been reduced, so that delta of 7% still continues, but still a competitive rate.
Perfect.
Amitabh, these are the overall take that I have some rationalization I thought could have been done in further in TCS provisions, which people were expecting it. It didn't come through, but something on the TDS front has happened. But TCS, I think, was one part where rationalization could have been done. But I think just talking pre-budget in few sessions, at least I got a hint that once the elephant sets in, it's very difficult to move. So perfect. Maybe it's a time.
Amitabh, quick takeaway on the indirect tax front. The more we think that there'll be less on the indirect tax front, we have enough on our plate. So there has been a lot of action on the indirect tax front, especially customs duty.
Absolutely, Arun. We will dwell into customs duty. Customs duty is largely rate changes, but I want to give one hit and one miss is that there was nothing spoken about GST in the entire speech, but the fine print talks exactly opposite. Lot of amendments based on 47th and 48th GST Council. All the amendment in the laws which were expected has come in, but budget speech had silence on GST. And the hit is the tax buoyancy. 22% GST collection growth, which gave a tax buoyancy of 1.1 on an overall basis. So the tax buoyancy is huge, which gives legroom on the capex expenditure. In spite of that, for the forthcoming budget, the tax buoyancy has been kept at 1. So they have not gone over as far as budgeting the tax numbers for the next year is concerned.
Perfect.
Just one comment to that, with
Sure,
Amit
sure.
making a very important point on the tax buoyancy, and spoke that before even the pre-budget yesterday. That has given the legroom to the finance minister to do whatever she has done. So if assuming that number of 34,000 crore is right number, reduction in tax because of overall, tweaking, new tax regime, whatever you call it, then that's one thing, legroom, which has given her the right. And hopefully with this better compliance, I think the tax collection should go even further.
Absolutely. Amitabh just referred to the 47-48 council meeting. Trust me, someone wrote in jest on Twitter that you could write a 500-page book on those council meeting decisions. So whatever has come in the budget is only an annexure. Don't worry.
Yes.
To a book. Yeah. With that, I hand it over to Uday Ved for a presentation on direct tax, followed by Amitabh's presentation on indirect tax, and we'll take your questions, comments. We are not short of time at all, so that is not going to be a hurdle today. Please keep your questions and comments coming in the chat box and in the Q&A section. Thank you. Over to you, Uday Ved.
Thank you, Arun. So I'll dwell straight into the direct tax proposals. Can we move the slide? So I think a lot has been spoken, I'm sure, since yesterday on this slide, and I did mention that something which was there to accept first that there is an issue and it has not worked. So the government has really worked on that to make it more a reality from a common man perspective. As I was saying, the rates, whatever were the 6 slabs, have been now reduced to 5. So not much change there, but the tweaking, when it looks at it, either vis-a-vis the new tax regime as is existing versus the proposed, or look at it the old regime, the existing regime with the incentive. Either way, there is a benefit on tax savings for everyone. Interestingly, this has been extended. It was only applicable to individual in HUF. The new regime, now proposed regime rather, talks about expanding to AOP and BOI is also an artificial jurisdiction person. So they expanded the scope. Anything other than say company and firm are now covered as a part of this regime. Old tax regime still continues. When one looks at this proposed NTR, it is applicable to all, whereas there are different tax rates for normal individuals and senior citizens. Here it is for one. So senior citizens still have a chance to look at their existing regime vis-a-vis proposed NTR. If that was one distinction, this question got raised somewhere yesterday to me on a panel. So I just thought I'll from that. But yeah, it is ease out more, and hopefully the filing will become much easier for individuals. Next, please. Again, when it looks at people at the high income bracket, more than 2 crores, where the surcharge currently is 37%, for more than 5 crores. That 37% surcharge has been proposed to be reduced to 25%. So now about 2 crores, the income is and a tax rate is same. That effectively means a reduction of about 4% in the tax rate, going down from approximate 43 to 39. And again, that's a very competitive rate. When I look at the global, even the 43% is not a high rate. In Europe, the tax rate in UK, as an example, a few other countries, Germany and other places, it is upward of 50%. In USA, effectively with the state taxes, it goes beyond 39-40. So now certainly 43 going to 39 is surely a good measure from that perspective. No other change except a surcharge above 5 crores. I think essentially it all talks about that once you go under the new regime, practically no deduction, no incentives, everything. On the life insurance policy, interestingly, people have used the LIC more than the insurance cover to getting effective returns from the policy, and there have been tweakings which have happened over years. This time, the provision which has been added is that if the premium exceeds 5 lakhs, when the proceeds are received, it will be taxable. Again, in line with the policy of not making retroactive amendment, when one goes to the fine print, interestingly, you find that it will only be applicable to policies issued on or after April 1, 2023. So it will apply only to new policies and not to the existing policy. The fact that we are still on February 2, I would believe there would be a rush in February and March. If anybody takes the policy, it will not be impacted by this change. And so I would believe there would be rush to get more insurance policies on that. Of course, any money received on the death of the individual is tax-free, even in this situation. But good part is that the change is prospective, and you still have 2 more months to plan if anybody wants to have a look at it. Next, please. India is a signatory to BAPS, and we have seen right from Action 1 to Action 15. Of course, Action 1 is getting implemented on the digital front now, and Pillar 1 and Pillar 2. But number of changes have happened over the last 5 to 6 years since 2015 when BAPS came into force. And we have anti-abuse measures not only under the tax treaties, but also under the Income Tax Act. And this year, 2 more changes have been specifically included in the Income Tax Act. Essentially, if one looks at 5627B, where startup or angel investors invest in a company by way of a fresh issue. Currently, the law applies only to the shares issued to a resident. And any money which comes from a non-resident is not covered under 5627B. Essentially, the provision says that if company, it applies to private limited company, company receives more than the fair value of shares, then it is a deemed gift, and the excess is taxable in the hands of the company. That applied only to the shares issued to a resident. Let's assume that the fair value of the face value is 10 rupee. Fair value as calculated by way of DCF method is 100, and if the shares were issued at 200, then only the excess 100 is taxable in the hands of company, which applied only when the shares have been received, shares have been issued by a fresh issue to resident. Now they have covered, the proposal is to cover both resident and non-resident. Now, will this impact any FDI? I think today's newspaper already started talking about it. I would believe it is more, the rationalization more than anything else. There was no real reason for distinguishing here between resident and non-resident. Of course, for startups and approved startups, there is a formal exemption possible by applying to CBDT. And we have seen a number of cases in that situation, the section itself does not apply. But in the absence of a startup, approved startup, now the law will cover both residents and non-residents. When one looked at section 9, the gift to a non-resident is not taxable, assuming the gift is completed outside India and income accrues or arises outside India, essentially section 56. Here, some cases came to a light where even the RNOR were taking that benefit, saying that it's an income accruing or rising outside India and not taxable. So that's an anti-abusive provision by saying covering not ordinary resident will now be covered by a specific scope under 918, Roman 18 of the Income Tax Act. This is again a anti-abuse provision which people were taking advantage. This of course belongs to the non-relatives and not to the relatives. And then some of them, the set off, something relating to house property will not be claimed, but I think these are more relevant. But the 2 key provisions as I look at it are the 5627B and 918. And the last part now, the distribution made by the business trust to unit holders in the form of repayment of debt does not suffer tax today in the hands of unit holder or business trust. So to avoid this dual non-taxation, the change is proposed by saying that any distribution in the hands of a unit holder will be taxed as income from other sources. Next, please. Some investment boosters, we were expecting changes in the IFSC. The government is really promoting IFSC, the gift city, to be one of the best financial centers, and of course in the country, but competing with the world. Why we need London or a New York or a Singapore or a Hong Kong? And that's the objective of IFSC. The law is in place, single window clearance, but further tweaking has been done. The relocation about in 3 years back in the Finance Bill 2020, the relocation of the fund from overseas to IFSC was being exempt. Now that exemption has been extended, the sunset close up to March 31, 2025. Then exemption to a single window clearance and will be available now with all authorities being there, the IFSC, the SEZ authorities, GST, RBI, SEBI. So it's more rather than going to different authorities, a single window clearance. Exemption has been also provided now to non-resident on transfer of offshore derivative instrument. This was more for the, I think, interest on the debt, which was taxable. Only the capital gains were exempt. That change has been made. For the startups, profit link exemption, because of the COVID, the entire world has suffered. So the exemption has been extended by 1 more year. If any startup incorporated before April 1, 2024 will be eligible for that 3-year exemption, which has been there in the Act. And interestingly, because the startups do have the losses in the beginning, so that carry forward and set off of losses, the time period increased from 7 years to 10 years from the date of incorporation, to make the startups more real eligible for benefit. They don't have profits in the beginning. It may be a long-term game, particularly in a lot of startups in the tech industry. Next, please. So when I just come to capital gains, I would request my co-partner Krishna from Bangalore to maybe take it over and put it and explain the provisions. Krishna, you there?
Yeah, yes, sir. Yeah, so looking at capital gains provisions now, so one of the key provisions which has been proposed is conversion of gold into electronic gold receipts and vice versa, which is now going to be considered as an exempt transfer under Section 47 of the Income Tax Act. This is actually, in a sense, if you look at the overall direction in which India is moving, it is a very positive direction because it curbs import of physical gold and promotes digital holding of the same form of asset. What then happens as a consequence is eventually when the asset is converted either from electronic gold receipt into gold or from gold into electronic gold receipt, the future transaction of sale of asset will include the initial period of holding. The next is more of a debated matter of cost of acquisition for self-generated intangible assets, where they have now again provided that the cost of acquisition will be nil. Likewise, the cost of improvement as well in relation to such assets is going to be considered as nil. The next item is in relation to capital gains on transfer of market-linked debentures. Earlier, the provision was being taxed under long-term capital gains, but considering the peculiar nature of the transaction, where there is a certain amount of interest involved as well as certain amount of redemption involved, now converted the transaction of either transfer, redemption, or maturity. The entire amount is going to be considered as short-term capital gains and will be taxed at the appropriate rates. Thereafter, the next set of amendment is actually targeting the HNI sector. And if you look at the provision, this is again in line with some of the earlier years provisions of restricting VPF contribution, enhancing the surcharge HNIs. This is again moving in a similar direction. So there is now a threshold of 10 crores, which has been imposed both under sections 54 and 54F, which are more in the nature of incentive provisions. By and large, should not apply the traditional urban middle class and will be impacting the HNI sector altogether. Next slide, please. Coming to transfer pricing, so certain class of NBFCs to be excluded from restriction. If you look at the existing provisions, banks were already covered under the provision of Section 94B. NBFCs have now been included under the same purview. And the limit for finishing transfer pricing documentation. So the existing provision was that any documentation had the time limit of 30 days for submitting to the revenue authorities, but that has now been reduced to 10 days, which ideally should be translated into a faster transfer pricing proceedings. The last transfer pricing amendment is in relation to transactions between cooperative societies and other person with close connection now within the ambit of specified domestic transactions, which is covered under Section 92BA of the Income Tax Act. There are some rationalization provisions under TDS and TCS. So if we look at the first provision, withholding of tax at the rate of 20% as against 30% where no PAN was made available by the employees. Effectively, what the budget seems to indicate is that there are certain categories of employees either at the slab rate of 10% or 20%, but are suffering taxes at the rate of 30% for want of PAN. And therefore, they are now saying that we will go ahead with a rate of 20% as against the existing rate of 30% in case of non-availability of PAN. The next change is in relation to TDS on interest on listed debentures. Currently, there is a provision which provides an exemption from withholding tax in the context of listed debentures. However, what has been observed is there has been underreporting of income considering that there is no TDS which is taking place on this transaction. So therefore, that exemption is being taken away now and TDS will now be required to be done on listed debentures. The next set is in relation to online gaming. There's a TDS which has now been introduced at the rate of 30%. Considering the boom in the online and electronic sector games, this is going to be a big hit to the electronic sector, especially in the online gaming sector. There's an increase in the threshold limit for cash withdrawal. The existing threshold of 1 crore has been increased to 3 crores for TDS under 194N. There's a widening of the definition of benefit purposes under 194R. So if you look at what was being covered earlier, the intent was to cover both benefits and perquisites in cash, partly in cash and partly in kind. That has now been clarified. Specified mutual funds under 196A, the existing provisions under 196A only provide for withholding of taxes at the rate of 20%. However, there was a long-standing debate of whether treaty benefit should have been available for specified mutual funds under 196A. That has now been provided, and rate as prescribed under the treaty will continue to be will now be available for taxpayers. Eligibility of persons to apply for lower withholding certificate. So again, 194 LBA in relation to distribution of income, which is a new provision which has been brought in, are now eligible to apply for a lower withholding certificate. Under the existing provisions of Section 197, 194 LBA was not covered. So it is more of an enabling provision to ensure that business trusts who are covered under 194 LBA can now go ahead and obtain a lower withholding certificate. Amendments in Section 206 AB and 206 CCA to exclude a person who is not required to furnish a return of income. So what is happening is, even in cases where a person had not filed a return of income in prior years, was suffering a higher rate of TCS. So this amendment seeks to clarify that where a person was not required to file a return of income to start with, will not be subjected to a higher threshold of TCS. On TCS on overseas tour packages and remittances, that has been enhanced. There are existing provisions of TCS for 5% on overseas tour package, and in other cases 5% with a threshold of 7 lakhs, which has now been increased to 20% in both categories without any threshold limit. Certain other measures are there in relation to assessments. So the time limit for completion of assessment proceedings has now been increased from 9 months to 12 months for assessment year 2022-23 onwards. Facility to assessee for making an application to the assessing officer for grant of TDS where credit was not provided earlier, and TDS credit is now available considering the cash system followed by the taxpayer. The next amendment is in relation to creating a new level of hierarchy. There is something known as a joint commissioner which has been created. The Joint Commissioner will operate at a parallel level to the Commissioner Appeals and will have similar powers which are available to the Commissioner Appeals. Effectively, this is a measure taken to increase the traction in the decision making of the Commissioner Appeals, considering there's a high level of pendency of matters at that stage. Tax authorities are enabled to file cross objections against appeals filed by assessee against the final order passed by assessing officer pursuant to BRP directions. Currently, what was happening is in cases where the assessee was filing an appeal against the DRP directions, the revenue had no recourse other than to object against the final order. So a mechanism to file cross objections is now made available to the tax authorities. Come into process in the last few years. Simultaneously, what was happening is the liquidator was taking certain actions under Section 178 of the Act, and wherever there was non-compliance observed under Section 178, either in terms of issuing notices or in terms of following the protocol in the distribution of assets, there were proceedings which were being initiated against the liquidator. Now, considering the fact that the liquidator is required to operate under the guidance of the Insolvency and Bankruptcy Code, those proceedings have been formalized, and effectively they've said, we will no longer treat this as a prosecutionable offense. The next amendment actually was a long-standing expected amendment, considering ACZ units have existed for ages together and the sunset clauses have also lapsed. But to some extent, considering that ACZs which were set up in the past few years will continue to make tax holiday claims in the next few years as well. And if you look at the existing Section 10AA of the Act, which is applicable to ACZ units, there is no requirement which is explicitly coming out that the return of income has to be filed on or before the due date in order to claim the tax holiday. And if you look at most of the tax incentive provisions, whether it is Section 10A or 10B or some of the Chapter 6 related provisions, most of them invariably link the tax holiday or the deduction or the incentive to the prompt filing of the income tax return within the due date. So 10AA also has now introduced that condition. Another condition which was not existing under the Income Tax Act of 10AA was realization of export proceeds. Again, there was an ongoing debate back and forth as to whether export proceeds which are required to be realized in accordance with exchange control regulation should be brought into the Income Tax Act, or should it be viewed as even if something is not in compliance with the exchange control regulations, but on a standalone basis is eventually brought in or not brought in, can be eligible for tax holiday. Therefore, the budget now proposes that period of 6 months from the end of the financial year will be considered as the threshold for bringing in foreign currency. Along with this, actually, there was another amendment as well, which may be a bit peculiar, considering the nature of the transaction. What was being proposed was any realization of export proceeds to a bank account maintained outside India will also be considered as realization of export proceeds within India, provided the bank account is maintained and operated and maintained with the approval of the Reserve Bank of India. Effectively, the provision is applicable for MNCs which are operating under branch offices overseas and maintaining a bank account outside India. And the regularization of bank account is very critical in this aspect. The next aspect is in relation to benefits or perquisite fully or partly in cash taxable under Section 28(4). Again, the jurisprudence on this aspect was to some extent moving towards the direction that any cash benefit provided should not be covered under the ambit of Section 28(4). That has now been amended and brought in under the provision of Section 28(4) explicitly. The next amendment actually is more of what should have been a highlight amongst the professionals like us, as well as for the MSME sectors, considering the presumptive rate of taxation which has been increased and simplified to some extent. Considering MSMEs, the existing rate of 2 crores has been increased to 3 crores, and for professionals, the threshold has been raised from 50 lakhs to 75 lakhs, subject to the overall cash receipts not exceeding more than 5%. This should typically help most professionals if you look at the threshold, and considering 50% of gross receipts are supposed to be taxed under 44 ADA of the Income Tax Act, this is a very beneficial provision. Similarly, in order to facilitate the business of MSMEs, what has now been proposed is any payments which are made to MSMEs will be allowed only on a payment basis. And the provision has also been linked to Section 43B of the Income Tax Act. However, what has also been tried to be done is if any payment is being done under the proviso of 43B, which is applicable in the context of a return of income being filed and the payment being made within the due date for filing of return, that provision has been made an exception. So effectively what happens is any payments made to MSMEs within the period of 15 days, which is applicable under the MSME Act, is what is going to be allowed, or it will be allowed on an actual payment basis. The last amendment is again more in terms of a tightening of compliance measures, where the revenue authorities are now saying that any SSC claiming deduction under 35D for preliminary expenses will now be required to furnish a statement with the prescribed particulars within the prescribed time and manner as may be prescribed.
Thank you, Krishna. So, Arun, anything to chip in, or should I go to GST?
No, absolutely. Let's ensure continuity, consistency, and continuity, Amitabh, with GST.
Thank you. So let me just look at the glimpse of the numbers first, as I was talking about on the tax buoyancy. If you look at the collections on the left and top side, you see that as far as indirect taxes is concerned, it is growing from 14 lakh crores to 15.3 lakh crores. But there, if you see at the bottom below that, the principal indirect taxes, the collection is usually coming from GST. 21-22 is 6.98 lakh crores to 8.5, and then growing to 9.5. So the collection is down as far as customs is concerned. Customs is nearly same, but excise is coming down, and that is what is keeping the total indirect tax collections down. But if you look at GST, 22% growth in 22-23, and only 12% growth estimated in 23-24 budget. And if you look at the top right chart, which is the growth chart, both the taxes, direct and indirect, is estimated only at 10.45% growth, which is in absolute numbers, the GDP will grow at the same percentage in absolute terms, in the present money terms. And hence we are saying the tax buoyancy is only kept at 1, though in earlier 2 to 3 years average, the tax buoyancy was 1.1. And if you look at the direct taxes, GST is overtaken both the corporate tax and the personal income tax. So GST has become a key revenue driver, which also the economic survey mentioned. GST is becoming a key revenue driver for the government, both the center and the state. Coming to the specific provisions on GST, there was no mention about GST in the finance minister's speech, but the fine print has a lot of it. As far as the electronic commerce operators is concerned, what was expected based on the recommendations of the GST Council meetings was that when a person is supplying goods through an electronic commerce operator, currently that person has to mandatorily take registration irrespective of the threshold limit of the turnover. So even if I'm supplying 1 rupee goods through an electronic commerce operator, I need to take registration. So there is no threshold limit prescribed for such a person. The recommendation was to waive that mandatory requirement, which is not seen in the finance bill. So the finance bill has not followed the recommendation. However, there are 2 things which has come in, is that such a person will be allowed to opt for composition scheme. And second is that where an electronic operator allows such unregistered persons to supply goods through it, then the electronic commerce operator would be penalized. And somebody who opts for composition scheme, he is not allowed to do interstate supplies. Now, if somebody has opted for composition scheme, obviously he would not pay GST through the electronic commerce operator, but then he cannot be doing interstate supplies. So if the e-commerce operator allows such a person to do interstate supplies, again, the electronic commerce operator would be penalized. And if electronic commerce operator is required to furnish certain required details of what transactions has taken place through it about the registered suppliers, unregistered suppliers, and if electronic commerce operator fails to furnish such details, again, he would be penalized. As far as input tax credit is concerned, I'll take the second bullet first, because that's concerning most of the corporates. As far as spending on goods and services which are used or intended to be used for CSR activities, input tax credit in respect of such goods and services used or intended to be used would not be available, will not be allowed. And what the fine print is saying that here, what is CSR is what is referred in section 135 of the Companies Act. What it means is that this amendment will come in when the Finance Act is enacted or the bill is enacted. It means that as far as till the finance bill is enacted, the credit was allowed. This is not a retrospective amendment. That would be the natural interpretation. As far as the value of supply of warehouse goods is concerned, before the clearance for home consumption, we'll talk about it. This value is now to be included in the value of exempt supply, which would mean that it could have an impact possibly on the input tax credit. As far as filing of returns is concerned, now there is a restriction that the details which are furnished for output supplies or returns or statements, they will not be allowed to be furnished after the expiry of 3 years from the due date. Currently, there is no such embargo. If I want to file returns for last 4 years, I can file it. But now they're saying after 3 years, you will not be allowed to file any returns or details or statements. There was an amendment in 2019 that transactions which are taking place outside India. So if somebody is supplying goods from Germany to Spain, then that transaction is not going to be regarded as a supply. The Germany guy may invoice India, India may invoice Spain, but goods are getting directly supplied, or an high seas sale, or supply of warehouse goods. If the goods have come into India, but they're warehoused before the custom frontiers, and they are transferred in the custom frontiers before crossing the custom frontiers itself, such supplies were kept outside the purview of GST. But this amendment came in from 1st February 2019. The question was, what happens from July 17 to 31st January 2019? Now the amendment is being made retrospective to say even for the period July 17 to 31st January 2019, it would be regarded as outside the purview, so it is outside the scope. However, the supply of warehouse goods, that has been added for the value of exempt supply, what we spoke about. If anybody has paid tax during that period of July 17 to January 19, then obviously that would not be reflected. Decriminalization of certain offenses was expected as per the recommendations of the GST Council. What they have done is that the threshold limit of 1 crore is been increased to 2 crores for certain prosecution for certain offenses. However, the issuance of invoice without the supply of goods, for that the prosecution would happen and the limit will continue to be 1 crore. And certain offenses of not cooperating with the tax officer or not making disclosures, those items has been removed for the purpose of prosecution. As far as compounding of offenses is concerned, certain items has been added that this will be considered for compounding, and the limit of compounding was 10,000 rupees or 50% of the tax demand to 30,000 rupees or 150% of the tax demand, whichever is higher. That compounding fee or amount has been reduced to 25% to 100% of the tax amount. Couple of important changes which impact industry are widely, that if one is availing transportation of goods related services and the transportation is such that the goods are going to go outside India, then the provision was that if the goods are destined outside India, then the place of supply would be treated as outside India. Now that provision has been changed. It is stated that it will not be destination of goods, but if it is B2B transaction, then the location of the registration of the recipient, and if it is B2C, then where the goods are handed over. Would mean that if the goods are going outside India, hitherto they were not liable to tax or not liable to GST, they will become liable to GST. As far as definition of non-taxable online recipient is concerned, there were two conditions. One is the recipient is not registered, and second condition is that the services are used for other than commerce. Now, there is a problem that if I am a non-resident and I'm supplying services to a person, he is not registered, but he may be using that services for business or commerce. Now, for me as a non-resident, it is difficult to identify how is that person using the services. He may be not registered for GST purpose, but still a business, maybe below the threshold limit or some other reasons. Because it was not possible to put the check, the condition that the goods are being used or services are being used for other than commerce or industry has been deleted from the definition. That would mean that any person who's not registered will be regarded as non-taxable online recipient. So if a non-resident is providing services to an unregistered person, the non-resident has to register in India and pay GST. And generally for OIDA services, electronically supplied services, these things happen. And the definition was saying that for OIDA, if it is the services are provided through information technology and through electronic network with essentially being automated and involving minimal human intervention, then it was OIDA. Now, essentially automated and involving minimal human intervention, these words are deleted from the definition. What it would mean is that a lot of services now will get covered under OIDA, because we would say that these are not necessarily essentially automated, and it requires a human intervention for me to deliver, and hence it is not an OIDA. That was an argument in many situations. That argument would not be possible with the deletion of these words from the definition. There is an enabling provision taken to say that any information which is given to the government on the GST portal, they could share with such other systems, obviously with the consent of the supplier and recipient. As far as custom duty proposals are concerned, in 2021, the conditional exemptions which are provided under customs law, a validity period of 2 years was made for all such conditional exemptions. That would mean a conditional exemption coming in after 2021, it would have a sunset clause automatically after 2 years. It was 31st March falling after the 2 years. The proposed amendment is that this validity or this sunset clause would not apply where the conditional exemptions are pursuant to a multilateral trade or a bilateral trade agreements or an international agreements or scheme under foreign trade policy or scheme of any central government. As far as settlement of cases is concerned, it is provided that the adjudication would be done now within 9 months from the date of filing. And if the adjudication is not done, then the case would revert back to the adjudicating officer. Lot of changes on the custom duty rates. Many coming in from the midnight of today morning, which is from 2nd February. You'll see on the screens that custom duty rates were increased on specified chemicals, rubbers, precious metals, imitation jewelry, electrical chimneys, bicycle, toys, and parts of toys. On many items, a recalibration has been done whereby the basic custom duty rate has been reduced. We heard from the finance minister, the number of duties has been reduced from 21 to 30. So the basic custom duty rates were reduced. However, the agricultural infrastructure development cess and SWC was increased such that the total incidence of the custom duty remains intact. Some changes on the duty rates, which we heard also from the finance minister in the speech, crude glycerin there, denatured ethyl alcohol there. The finance minister also spoke about the lab-grown diamonds because of the green, the focus on the green, and on the marine, the duty has been reduced. Electronic goods, camera lens, specified parts of open cell of TV panel, the rate is reduced. Heat coil chimney was mentioned in the budget speech. Specified capital goods which are used for lithium cell of use in battery. Again, this is from the green perspective. Automobiles, again, the focus is on the green side. So the rates were increased for where there are fossil fuels. With respect to exemptions, there were sunset clauses for many exemptions to end on 31st March 23. Certain exemptions, the sunset clause has been extended by 1 year to end on 31st March 24. Solar power plant and solar power projects are excluded from the purview of project import. So every item which is imported for that plant or project would get taxed at the respective rates. And very interestingly, what has been done is based on HSN 2022, a lot of amendment was made in the way the HSN is interpreted. Mozzarella cheese was not there separately. Certain medicinal plants were not there. Certain telecom products were not there, which is coming in because of the change in technology. So all these products has been now added into the HSN classification, and accordingly, HSN classification has got revised. So the budget now, or the finance bill now, provides the provision that our custom tariff is also amended to include all those items as per HSN 22. All this impact will be made from May 1st, 2023. As far as central excise duty is concerned, NCCD on specified cigarettes has been increased. Very interesting change. There is no fungibility of GST and excise, but for blended CNG, this fungibility has been brought in, that if biogas and compressed biogas is used for blending the CNG, then the GST paid on biogas will be allowed to be offset, if I can use that term, to the extent central excise duty is payable on that. These are some of the key changes from our side. Happy to take questions.
Yeah, thanks. Amitabh, my favorite part of the presentation was the classification of mozzarella cheese.
It was not there, Arun, till now. It has just got added.
You know that today we reported this morning, and while on my way from Mumbai to Pune, I thought early morning, nothing to do, Supreme Court ka judgment aaya, let's draft the head note. And it was an important judgment expounding on the writ powers of the High Court. But more importantly, the underlying issue which it decided was classification of mosquito repellents. Yeah. And that too under the VAT law of Haryana. And the Supreme Court said, now instead of remanding this back to the High Court, 14 years have elapsed. Let us decide this.
Let us decide.
So, at times you get lucky with the courts in India. This was one of those occasions. Uday Ved, I'm going to come to you first. I think the biggest story yesterday, and in the run-up to the budget, last morning, yesterday morning, we said that the finance minister has a lot of wiggle room and fiscal space to do something big on the salaried side for the middle class taxpayers. The message is very clear that this old regime is going to go one day or the other. A new regime is what we want the taxpayers to opt for. Do you think enough incentive, and I know you were there on one of the most watched news channels yesterday, post-budget. So what's your advice to the salaried class? And then I'll come to Heena on what she's going to advise her employees at her colleagues at TechM, because TechM is one of the largest employers in the IT space. So Uday, first to you, how do you see this old versus new regime pattern?
No, I think the direction is very clear. It started with the changes in the corporate tax rate, reduced the rate significantly in last few years to 22% and 15%, and incentives have been reduced. So make it simple, right? And now it is going to individuals. Individuals, you need much more, I would say, a flat rate, and so the direction is very clear. The scheme which was put in 3-4 years back didn't work the way it was expected, and now hopefully I think with this it looks like that for a middle class definitely there is a relief. Interestingly, one exception which has been made is standard deduction. So standard deduction will be available up to 50,000, I think, even under the new regime. So that's one part. So I mean, getting a relief to the salaried class. So they're trying to make it simpler. Even look at it from an employer perspective, like say Heena. The 192 provisions will become much more simpler, right? If a company with thousands of people, there is always huge amount of time which goes into base salary and incentives and everything. And then there are litigation, not only for individuals, more for the corporates on the TDS side and the 192. Even that will ease out. So I think there is a simplicity. The direction is clear. Make it simple, and hopefully it also in terms of the final filings, the return which comes up, I would believe would actually sync with the actions which are sought to be taken. So sometimes the implementation is where there is a slip. So hopefully the direction is clear, policy is clear, and with everything going online, this should become.
Sure. Uday, I was just thinking, when I started my corporate career, with CNBC in 2004, at that time, what were the rates? And I'm not recollecting, but I suspect it was something like 1.5 to 2.5 lakh, 10%, then 2.5 to some, then 20%. And I think over 5 or 6 lakh was 30%. Now, you look at where we are today, I'm not sure whether we've adjusted for inflation or not, but from 5 lakh to 15 lakh, if the highest rate is at 15, that's not bad at all. Heena, you want to weigh in on that?
Yeah, so I think I would agree with what Uday said, and it's a real good impetus. They're bringing in clarity, they're bringing in simplicity, which should help reduce litigations. But just wondering, how many of us would opt for it, because this would kind of, where is the motivation for the saving now? Because if the mentality of employees is to kind of do these investments right towards the end of the year, these tax saving things. But now I don't think that that's going to happen, because if you're going in for the new regime, people will straight away, just calculate their taxes on the new regime, and there may not be any contributions to PF and PPF and all of that, which probably was giving some kind of saving leverage.
Heena, while deducting taxes,
just
1 second, Uday, just 1 second. While deducting taxes as an employer, Heena, will the default now be that you will deduct under the new regime, or will you first give an option to the employees and then make a call?
No, the option is given. That is how administratively we will function, and we've been doing so all along. There is an option available to the employee, which he has to opt for, and then the deduction happens accordingly.
Even today, there is an option, Arun.
Yeah.
The option is the new regime today.
Yeah.
Now the new regime is more a default regime. So unless you take, and they'll give some kind of a time limit to say, unless you opt for it, we will deduct on the new regime. Ma'am, with due respect, I little differ on the savings. Indians have a mentality. It is, and of course, it is tax is driving the saving, no question about it. But people will save whether we'll get tax or not. At one point of time, the tax saving rate was 37%. Okay, it went down to 31, I can tell you. Currently, it's gone back to 34. In excess of 30% at 3 trillion economy, we are generating 1 trillion. We don't need the rest of the world, theoretically. There's so much saving happening. So I don't think it is drastically going to fall. That's my view. I may be wrong totally. But it's driven by tax. But still, there is a normal mentality among the taxpayers. I don't talk necessarily about the new gen may have a different perspective.
Yeah.
Nobody wants to opt for PF or PPF, saying paisa de do, baad mein baat karenge,
Correct.
So yeah, I think it will be a mix of both. But till we are alive, we'll keep on saving, I'm sure.
I think post-COVID, the mentality has changed, and less and less people are saving. They want to spend more. So again, this would be an additional factor, where probably they'll spend more because there's no impetus for saving.
Yeah, it's a zindagi na milegi dobara syndrome. Anyway, but on this we have a question, and then we'll possibly have Tanaya. We have a lot of questions, almost 24 questions. So Tanaya will cherry pick some of them and put it to the panel. One on the topic that we are discussing: does the new regime make employer go away with PF contribution?
What did you say? Sorry,
Does the new regime make employer to go away with PF contribution?
No, I don't think so.
Enough?
No, I don't think so, because both the options run in parallel. So there is no question of doing away.
I mean, if there's somebody is opting for the old regime or existing, then we'll still go to what you are doing today, right?
Yeah.
Perfect. Perfect. And we can take a few questions, and then maybe I'll put one on there are a lot of anti-avoidance provisions. So I'm just wondering what direction are we taking there? Tanaya, can we take some questions from the audience?
Sure. So Lavan Gupta is asking, sir, he says, with relation to market-linked debentures, so he says, would STT be applicable on this, as the proposed section specifies that STT deduction would not be allowed? So if STT is applicable, then the rate of 15% under section 111 would be applicable. So if you can, clarify and share your thoughts.
Krishna, do you have any view on this? I have not looked at it. Yeah. You're mute.
You're on mute, yeah.
Yeah. Looking at the way the provisions are worded, 1 second. I'm just looking at what is the exact question.
Krishna, you want me to put it on chat?
Yeah, if you can just repeat the question.
I'll just do that. I'll just share it again on chat as well.
Till that time, I'll try to take another one. A lot of questions on TCS. Someone is asking, isn't it akin to a tax on capital? 20% on overseas remittance?
No, it is not a tax on capital. I would believe this is available as a credit, right? So it's not a cost. It's a cash flow issue. And possibly the thinking here is that someone who can remit 250 would certainly have a tax rate of about 30%, if not 43 or 39, whatever. So instead of 5%, it was introduced, just look at the genesis of this provision. It was introduced in 2020, I think, more as a tracking mechanism for LRS. Before that, there is no tracking mechanism for LRS. Whether you are exceeding 250, not 250, right? Reserve Bank didn't care at that point of time till you remitted, right? Now, at least there was a tracking by saying bank will deduct 5%, but it will be available as a tax credit to you. So it's not a cost. Now that 5% has been made 20% because they would have said, oh, those guys, and they've made exceptions. 1 or 2 exceptions still remain. But other than that, said 20% TDS, which is in line with, or TCS rather, in line with all other lot of those TDS provisions. But if somebody is making a remittance in the name of a family, right? Say I'm making 250 for 4 of us, husband, wife, and 2 children. Then there may be a refund situation. So it's not a cost.
So my
situation, but it's not a mechanism.
Perfect. Vaibhav, our good friend, Vaibhav says 20% TCS on LRS other than medical and education is very harsh. This should be challenged by the taxpayers in suitable forum. Yeah, we are happy to cover such a litigation. Yeah, Tanaya, can we quickly take the questions? We have lots of questions and lots of ground to cover.
On a lighter note, it can be challenged only when it is introduced. Once it is introduced, it's only a question of rate. So
I'm
not being negative, but I'm saying at the time of 5%, it could have been challenged. But yes, 20% from a cash flow perspective is harsh. There's no about it.
So Kamala is asking, would payment by employees to purchase shares of parent company abroad be covered under the 20% TCS? And similarly, would the payment under LRS for supporting boarding and lodging of children studying abroad fall under 20% TCS?
I think education has been kept outside. There's an exception. There are 3 things.
Medical and education.
Yes. For the purpose of education and medical treatment is still the same 5%, and 7 lakh limit also applies, by the way. So there are 4 changes which have happened. For the purpose of the education, 0.5%, the same thing, loan against loan 5%. The changes happen only for other than education, medical, and overseas tour package. Overseas tour package has removed it has remained at 5%, but without that threshold limit of 7 lakhs.
Right.
So essentially, the answer is that for purchasing shares abroad of your parent company, you will have to out that money. At TCS will have to be. Okay. Next one.
So Vikash is asking, in case of existing life insurance policies, whether the benefit is also available for renewals post April 23.
Renewals in the sense, it applies to new policies. I think it looks the existing policy is not covered. So if at all it was discontinued and are renewing it, whether it will be a fresh policy or not is a question. It looks like the fresh policy will be only covered. If it's a pure renewal and if you're discontinued in the past, hopefully in my view, it should not get triggered.
And the Revenue Secretary clarified on CNBC last night that this is the limit of 5 lakh premium is per policy and in a year is what I understood. I hope that is no longer confusing, Uday, right? I think that issue is now set at rest.
Yeah, I think so.
Yeah, because we do have a question on that aspect.
Yeah, please go ahead. Let's take the question.
No, the same thing that you just clarified, that is that insurance premium for one policy, or is it inclusive of all policies together amounting to 5 lakhs? So that is the question.
No, I think per policy.
Okay.
Per policy, right? Yeah.
Right. Another question to the panelists is the threshold of section 54 and 54F per transaction, or is it the overall lifetime capping of benefits? So the participant is saying, in my understanding, is that the limit of 10 crore separate for 54 and 54F? So if you could kindly confirm that aspect.
I think the total amount is 110 crores. So it's a total amount. I'm just reading, in order to prevent this, it is proposed to impose a limit on maximum deduction that can be claimed by the SSC under 54 and 55 to be 10 crores. It will be, in my view, it will cover both. Total deduction will be 10 crores, not more than that.
Okay.
Not separately for 54 and 54F. Again, this is in line with, I would say, the surcharge reduction which has happened, right? So just do away with the exemptions.
Yeah, but interestingly, Uday, what happens is if you look at both section 54 and 54, the threshold has been laid out separately. And in fact, it is a long-standing debate even under 54 and 54F as to whether both the deductions could be claimed simultaneously in the same year.
It can be, I think.
And that is where the controversy comes in as to the moment you prescribe 10 crores for 54 and separately for 54F, whether it is.
I'm not seeing the finance bill, but here, I think at least in the memorandum, it looks very clear. To me, it looks like both together.
Okay.
Total deduction, it is more for the taxation of an employee, an SSE.
Right. So we do have a couple of questions regarding the amendment to section 43B for the payment to MSMEs. So I think there's a lot of confusion with regards to that amongst the attendees. So one question it says is that whether the disallowance would operate in respect of only the outstanding as on the last day of the financial year and not paid within 45 days, that is if there is an agreement, and 15 days or otherwise, or the delays in the payments even during the year in payments to MSMEs would get disallowed.
This is a good one.
Yeah, I think looking at the way the provision is sought to be covered, I think it should be allowed on payment basis. So assuming the payments are incurred during the year and there's a delay of say whatever, like 50 days or 60 days, ideally it should be allowed as a deduction because the intent is to allow deduction on payment to MSMEs. So what should ideally be covered is outstandings as at year end.
So currently, Krishna, what happens is right now all the companies have to disclose whether there are any MSME dues and so on and so forth. I don't think the policymakers have realized that that some of these clauses actually go against MSMEs because a lot of companies want you to revise the invoice when they don't make a payment on time, and the MSMEs really don't have choice but to revise the invoice. It's so much more better when you draft such policies, it makes headlines, but on the ground it really doesn't work. As an MSME, I can vouch for it that when companies don't pay you on time, they ask you to revise the invoice. That's the reality.
And from the corporate front also, I think this brings in a lot of administration, tracking it, whether it's paid, unpaid, it brings in a lot of, so it kind of puts it to a disadvantage. Whether
you think twice before engaging an MSME then, right?
Yes.
Yeah. But anyway, as I said, but that's fine. Intent is good. Implementation is tough. of this provision. But Krishna, the point that you mentioned, the question could have multiple interpretations, because if you're anyway going to make it at the end of the year, if that's how you want to calculate, then the intent of the provision or why this has been introduced itself is lost. Because right now there's a 30-day, you have to make all MSME payments within 30 days, if my memory is right. So
Correct.
then if till the end of the year you can do it, then you don't need that provision in the first place. In any case, currently you have to provide for interest on delayed payments.
Correct. And that is where I think, so if you look at even the necessity for the provision to be linked to section 43B, they need not have done that. So effectively they've linked it to the section 43B saying, okay, it has to be on payment basis. But then they've also looked at the fact that, okay, I want to link it to 43B, but I don't want to extend it until the due date of the return of income under the proviso. So they are saying that, okay, we will give you the deduction provided you're still making the remittances. But I completely appreciate your point. The fact that you could raise an invoice on April 1st and still receive the payment on March 31st. Does it still warrant a disallowance?
Amitabh, one question for you.
It cannot be, sorry, it cannot be that a deduction will never be allowed, no?
Correct.
There could be the penal provisions for delay in the payment, but the payment basis, the deduction has to be allowed, I'm just saying. It's a legitimate business expense or whatever.
So, sir, there's one question to that. It says that when there's a non-payment to the MSME, then is that a permanent disallowance? So the participant Ashish is saying it looks like it's a permanent disallowance due to the amendment in the proviso.
Okay, this is something that we'll revisit and we'll get Krishna to write an article for us on this. Because this definitely can have multiple interpretations. Amitabh, one question on the indirect tax side, whether payment for database subscription to NR, example, payment to LinkedIn, Bloomberg, etc., whether GST on RCM will be applicable.
So if it is, if the recipient is a business or a registered taxpayer, then RCM would apply. And if the recipient is a non-taxable online recipient, as we discussed till the budget amendment, the old definition, after the budget amendment, new definition, then the service provider has to register in India. So LinkedIn Ireland, which it is registered in India, will be paying GST.
Great. Tanaya?
Yeah, we have one question from Kamala. She says this question is particularly for Heena ma'am. So she says, are there any key takeaways from the budget for IT and engineering consulting companies?
Okay. So not much other than the 10AA, there is a proposal to, not allow the 10AA deduction if you've not collected beyond the 6 months period after the end of financial year. So, but I don't know how much it's applicable, because many of them are now moving to the new tax regime, and very few entities, IT companies are still in the SEZ, under the SEZ Act. So that is one impact. Other than that, I don't think there's some minor things on the, one is this MSME payments, one is about so one beneficial point which I saw is about the TDS mismatch. That is not specifically for IT companies, but yes, it applies to all of us. You can go back and get your, refunds claimed back. So that's one beneficial thing that has come out of this. Other than that, I don't see anything beneficial for IT companies as such. Nothing major here.
Amitabh sir, I think you can shed light on this question. It's by Samir. He says, since there is a specific amendment regarding input credit not available on CSR expenses, can it be interpreted that currently input credit is allowed?
Yeah, that's what I said during my talk, that should be the logical interpretation, and we would take that interpretation, because it is not a retrospective amendment.
Okay. Another question is for the 43B MSME payables. They say they use the words payable to micro or small enterprises. So are medium enterprises covered or not?
Yeah, again, if you look at the definition of MSMEs under the MSMED Act, each of those phrases are separately defined, whether it is micro enterprise, small enterprise, or medium enterprise. And peculiarly, the finance bill covers only micro and small, and has left out medium enterprises. So by definition, it doesn't appear that medium enterprises are covered under the definition, under the scope of this. And also
I
on a
think-
related note, on your earlier point on what would have been the implication on section 111A, I think you are looking at market-linked debentures.
Debentures, yes.
So if you look at the memorandum explicitly says market-linked debentures are in fact listed securities to start with. And therefore, the presumption is if you are carrying out a transaction on the stock exchange on which STT is paid, then the logical applicable rates continue to apply where STT is paid. And if it is an off-market transaction, then the rates would have been different. And in fact, that is why the finance bill also says the rates as may be applicable, without explicitly saying that this is how it is going to be taxed.
Yeah, there is a simple question. We love simplicity, especially in taxation. What are the deductions we can take in the new tax regime?
Okay, once again.
There is a standard deduction, I think, which is now available.
That's all.
But apart from that, can we take any other deduction in the new regime?
So standard deduction is there. I think they've made allowance for family pension as well.
Okay. No ATG?
ATG doesn't seem to be covered under the new provisions.
All 80 is gone in my.
All 80 is gone. That's well said, Uday Bhai. So not much deductions that you have
That's
here.
I'm just saying that is the objective, right? So nobody stops you from continuing the existing regime. So
Yeah, there are some simple questions. One line answer. What are the new TCS rate for foreign tour package? I think it's 20%. The new TCS rate. Yeah, there's 194R and 28.4. Uday Bhai, there is quite a bit of controversy and a bit to be looked into. There is a question on 194R. Cash benefits now, it says amendment in 194R, cash benefits also covered. I thought amendment in 28.4 covers cash benefits as part of the perquisite definition. Whether the 194R amendment is applicable from 1st April 2023 onwards. In other words, TDS.
The change has happened last year. TDS came last year. Now, I think the only change which has come in 194R is they've just clarified more that it will apply to even part cash and part benefit. So either people say if it is benefit or cash, is part cash and part benefit also, it's more a clarificatory, I think.
Yeah, and there is one more amendment, not in 194R, but related to it, that any default will also attract now penalty and prosecution. Heena, so you have to be a lot more careful. But Heena, any practical experiences on 194R? IT companies have been one of the they have suffered the biggest impact of that. So any
No, I don't think so. It's not impacted us.
Oh, it's not.
Yeah.
Okay, then fine. Yeah, I think it's impacted more of the pharma companies and
yeah.
those with
more in the media and entertainment space, I can tell you.
Yeah.
The celebrities and endorsements and everything, which used to just go untaxed because there was no TDS, right? So if something was received in kind, it was nowhere recorded. So 24 to that extent was theoretical for a lot of people.
There's one question.
You have some experience in the area, that's what I'm telling you. So now the obligation has been cast on the deductor itself to say that, if necessary, take cash. So I think that change came last year, I'm just saying, a year back.
Yeah. HRA is not exempted under the new scheme. Do you think it will be helpful if that is allowed? But then it will open up the can of worms. So if you allow one, people will ask for another. So that's yeah. And we can take a few more questions. We have 8 more minutes to go.
So I will just, before we just go ahead with some questions, I had just 2-3 points, which, as an industry, we were expecting from the budget, which didn't come out. So one is on the GST, we are looking for an appellate tribunal, which still, in spite of 5 years post GST, we haven't heard of that. So I don't know where we are on that. The other is on Pillar 2. So we haven't heard much on that. I think all the other European nations, many countries are talking about Pillar 2 and how to put it in place. but I don't think we have any, we haven't spoken about this. I don't know whether there is going to be any clarity on this, because next year is when it actually kicks in, mostly. That's what OECD proposes. And lastly, I think we were looking for some clarity on SEP provisions, significant economic presence. I don't see anything coming there as well. So what is, business connection, all that is still, a doubtful scenario. So these were three things that at least we as an industry were expecting, but we haven't heard of. So, I mean, anything, Uday Ved?
So I think a very interesting point you are raising, and the question was whether there will be, see, in order to make this pillar 1 and pillar 2 effective, more say pillar 2, both, there has to be a change in the domestic tax rule. So if you look at the entire BEPS program, India has been one of the forefront, right? Transfer pricing, anti-abuse, everything has been introduced. And there was an expectation whether it will come in this year's budget. Maybe they are waiting for it. The way I understand, pillar 1 is mandatory, pillar 2 is not. But everybody in India is not a problem. India is anyway more than 15%. So the change, possibly India is waiting for, Big Brother, which is essentially USA. When it makes the change, the entire pillar 1 and pillar 2 will be effective in my view. This is my view personally. Otherwise, this entire pillar 1, pillar 2 discussion will be theoretical. We will provide a lot of tax advice, but no implementation unless USA passes this law, because that's the final verdict. Once they do that, maybe India is waiting, and the change can come in the form of an amendment act also, right? So it doesn't need to come. It's because it didn't come in Finance Bill 23 that now it will be only Finance Bill 24. It can come in the middle of the year also. So maybe that's a wait and watch policy. But India is committed to both pillar 1 and pillar 2, in my view. So I think in whatever talks that we have had, pillar 1 is mandatory, as I said. So SEZ is already in place. Then in that sense, today it is more on a piece of paper, because if it's a treaty country, then SEP has no applicability. And when the SEP was introduced about 4 years back, when pillar 1 discussion had just started, action 1, at that time the memorandum did say that we will use this opportunity to renegotiate the tax treaties, to bring pillar 1 new article 5 or within change as by way of MLC 2 rather. But I think the interesting point is what happens today, right? You're right, whether there are any compliance requirements or not. Any thoughts on that? Yeah.
Yeah, because on the definition of business connection, and if you're making any payments to your overseas non-resident party or beyond 2 crores, I think they are required to file their returns and comply in India. So I think there has to be clarity, because you'll have hordes of payments being done, and whether those parties are required to do their filings in India, I don't think there's clarity on that bit.
Even if you are from a treaty country.
Yes. Even if you're from a treaty country.
When the income may not be taxable, we don't know. You still need to do filing.
Correct. So 911, yeah.
Yeah, interesting. Yeah.
And Heena, on your question on the GST Appellate Tribunal, in the 47th Council meeting, which was held in June or July last year, it was agreed that they will constitute a group of ministers. A group would be formed. Now, to best of my knowledge, that group has still not been formed. 48 meeting was silent. So I think we will have to still wait, because the group will get formed, they will discuss, they will recommend, then the recommendation of the group will be discussed by the council, then council is going to recommend, and then it will come in the law. So I think it's going to take some time.
Which means a lot of pile up once again.
Yes.
Yeah, a lot of pile up, and once the tribunal comes, a lot of work for all of us.
Yes. Already a lot of work is happening, because which one to take to the writ and which one to wait, that itself become question every time.
Yeah, the writ courts are also being clogged.
Yeah.
True. Perfect. Because they don't have an alternate remedy. At least the writs are maintainable. Yeah. Tana, we have 3 more minutes to go. We can take 2 more questions.
Sure. So we have one follow-up question on the fact that there's no amendment on pillar 2. So Harshita says the benefit of Dubai, Mauritius structures are still beneficial. So any take on this?
No, so today, yes, when the pillar 2 comes into the picture, then those changes will come into impact. Till that, all the structures are okay. And the whole question of, particularly for Dubai, UAE, the question was whether UAE will be forced to introduce corporate tax because of Pillar 2, which they have done it already. So just to comply with Pillar 2, you have a 9% tax right now, which will come into effect in, I think, June or July of 2023. But they also made a statement that for Pillar 2 companies, so in excess of that 750 million, wherever is the limit, tied up with the transfer pricing CBCR limit, they will have 15% tax. Because what happens is, in the absence of that tax, under the Pillar 2 as it is proposed, the parent company gets a right to tax the income. So say, for example, in an outbound scenario, India has Indian parent, say Tech Mahindra as an example, has invested a holding company in Dubai. Dubai has invested into operating companies all over the world. Money comes in Dubai and Dubai does not tax it. The differential tax rate can be taxed by India by way of the what is called the income inclusion rule. So why should Dubai lose out on that? So they will introduce a structure. Today, independent of Pillar 2, Dubai, Mauritius, all those structures can be covered under the anti-abuse provision, Action 6 and everything, which is already happening right now, whether it is inbound, outbound. But Pillar 2 will make it more relevant, I think. You're right. As I said, it is still optional. Pillar 2 is not mandatory. Pillar 1 is mandatory, even if you are signatory to that.
Yeah. Last question. This one should be simple. 54 and 54F together, the limit of 10 crore or individually 10 crore each?
I think I mentioned that at least the memorandum, I have not seen the fine print, honestly, on this. But the memorandum seems to suggest that it is both put together.
Okay. 54 and 54F.
Yeah. It seems that way.
Very interesting. The rationale for this amendment they have said is that the HNIs are abusing this or misusing this provision to buy costly residential property. I'm not sure whether this is going to bring down the cost of living anywhere. But yeah, it seems that the HNIs, at least on the, maybe the data that the CBDT has might be very clear. The HNIs who are benefiting more from this.
The law provides for it. People are investing. That's how I look at it. The law does not provide, people will do what they want to do. They may still invest, not get the tax exemption beyond a point. But certainly it was encouraging. I can only tell you that we have experience on this, that the tax is driving that force. At that point, 24%, amounts to a huge amount. I mean,
Yeah. A lot of tax foregone otherwise might come now into the tax net, because you have at least in the last 2 years, when the valuations of the unlisted companies, startups, unicorns were booming, there have been significant exits and liquidity events which people have, where the investments and capital gains have been plowed back into residential housing. That is no longer an option. The restriction is on 10 up to 10 CR. Final closing remarks from all our panelists, starting with you, Amitabh.
It is an excellent budget, I would say. It is very pragmatic, and that's where I would stop.
Pragmatic, says Amitabh. That's not usually what you hear about tax provisions of a budget, but pragmatic, that means it scored very high on, at least as far as Amitabh is concerned. Heena?
I think it's good in some areas. No surprises. So I think that's good if there are no negative surprises. So good. I mean, overall.
Heena, one more time you say that, next time you'll have 2, not 1 negative. Yeah, maybe they're saving the gunpowder for next year. All the surprises are going to come next year. Who knows? You may have a new income tax code. That's my bet. You're going to have a new income tax code next year. Heena, be prepared.
Let's be prepared. Yes.
Uday Ved, closing remarks.
If we look at our PPT, we have named it as continuity and stability. So I think it's a path. So the good thing about in last few years, there is a path. We are seeing it like no surprises. I think that itself is good one. So stability, I would say. continuity in the policies, which is good from larger corporate perspective.
Yeah.
And
Continuity.
moving towards tech, everything is tech driven.
Yeah.
Oh, terrific. Continuity, stability, and hopefully that means tax certainty. On that note, thanks so much, Uday Bhai, Amitabh, Heena, Krishna. Thank you so much, and thanks to the audience. We could not accommodate everyone today in the Zoom panel, but I hope some of you could join via the YouTube link. Else, we will share the link. You can watch it on the reservoir. You can watch the entire panel once again on YouTube. And apologies for not being able to take all questions. We had over 60
questions unanswered, Arun, we can take it up separately. So
we will try.
If you can try and send
surely
the email,
surely.
we can
Yeah, we were able to club a lot of questions and answer as many as we could. Forgive us for the constraint of time, but thanks everyone. It's a pleasure to be collaborating with KNAV for this budget webinar. We've made it a habit now. I think 3 strikes now. So 4th one next year is going to be big. Maybe not the vote on account, but the one after that. We are going to have an interesting budget next year. Watch out. Till then, goodbye to everyone. Stay glued to taxsutra.com for roadblock coverage of Union Budget 2023. One quick plugin. We are launching a very big book, a commentary on FEMA by Dr. Dilip K. Sheth, one of the FEMA legends. Based out of Mumbai, and you can read his treatise on FEMA law and practice. You can pre-order it on Taxsutra Reservoir. The book will be launched later this week. Pre-order your copy. If you're a professional practitioner or a corporate, this book will be very, very handy. Very few books on FEMA. This one tops the game. Thank you, everyone. Have a wonderful day and budget week ahead.
Thank you.
Thank
Thank you.
Thank you.
And all participants. Thank you very much.
Thank you.